$200.6 billion. That's the biggest quarter in Amazon's entire history, reported just 3 weeks ago. And buried inside that record number is the clearest warning about the U.S. economy we've seen in years. Amazon CEO Andy Jassy told Wall Street exactly where that money is coming from. And I quote, "Very significant traction in our everyday essentials and in our grocery items." Essentials, groceries, survival spending. That's why we're telling you Amazon just warned the U.S. economy is in serious trouble. The company that sees 40% of everything America buys online is watching 175 million households trade down in real time. And everyone, the data underneath backs it up. Number one, we're going to show you the 68 housing markets where home prices are already falling, and whether yours is on that list. Number two, we're going to show you the single number that decides whether America's frozen housing market starts falling next. Stick with us. Now, let me show you what's actually inside that record quarter, because this is where it gets interesting. Amazon reported net sales of $200.6 billion for Q2 2026, up 20% year over year, the first $200 billion quarter in company history. Operating income jumped 43% to $27.5 billion. The headline net income of $62.6 billion even includes a one-time $53.4 billion accounting gain from revaluing an investment. So yes, the underlying business is genuinely strong. So why are we calling this a warning? Because of where the growth is coming from. Amazon's monthly active customers buying perishable groceries are up roughly 50% year to date. Its grocery business has crossed $150 billion in gross merchandise value, the number 2 grocery seller in America. And on Prime Day, more than 80% of the deals were the lowest price of the entire year. Think about that. The growth engine of the world's biggest online retailer is now milk, eggs, and bargain hunting. And Amazon's own behavior tells you management sees it too. In October 2025, Amazon announced roughly 14,000 corporate job cuts. In January 2026, another 16,000. That's about 30,000 corporate roles, around 9% of its corporate workforce, the largest corporate reduction in the company's history, announced while revenue was setting records. So here's our take, and it goes beyond anything you'll hear in the mainstream coverage. The strongest quarter in Amazon's history is itself the recession signal. When a company posts record revenue because 175 million households are trading down to essentials and chasing the lowest price of the year, that's not a growth story. That's a strain story wearing a growth costume. And according to the Bureau of Economic Analysis, consumer spending is 68% of U.S. GDP. When the American consumer shifts into survival mode, everything downstream feels it, and housing is standing directly downstream. And here's the really alarming part. Amazon is not alone. This week, Walmart, the value king of American retail, missed its comparable sales estimates for the first time in more than 5 years. U.S. comp sales grew just 2.6%, down sharply from 4.6% a year ago, and the stock fell roughly 8% in a single session. Target is cutting prices on more than 10,000 items just to keep shoppers walking through the door. The Census Bureau reported retail sales fell 0.6% in July, the first monthly decline since October 2025, with online sales down 2.2%. The Conference Board's Expectations Index, which measures how consumers feel about income, business, and jobs over the next 6 months, sits at 74.7. Any reading below 80 has historically signaled a recession within the next year, and it's been below 80 every single month since February 2025. The University of Michigan's Consumer Sentiment Index just fell 8% in August to 51. Then came the number that confirmed all of it. On August 7th, the Bureau of Labor Statistics reported the U.S. economy lost 23,000 jobs in July, the first negative month of this entire cycle, and revised the prior 2 months down by a combined 103,000 jobs. The unemployment rate ticked up to 4.1%, and labor force participation fell to 61.4%, a 5-year low. Wage growth slowed to 3.2%, the weakest since May 2021. Meanwhile, the New York Fed reports total household debt at $18.8 trillion, with credit card balances hitting $1.26 trillion in Q2 2026, closing in on the all-time record, with average interest rates of 22.15% on accounts carrying a balance. The New York Fed's own researchers are describing a K-shaped economy, the top half still spending, the bottom half visibly strained. Falling confidence, rising credit card debt, shrinking payrolls, and record retailers built on trade downs. That is the exact convergence that precedes housing trouble. Which brings me to the first thing I promised you. The 68 housing markets where home prices are already falling. According to Resi Club Analytics, working from the Zillow Home Value Index, 68 of the 300 largest metro areas in America, 23% of them, posted year-over-year price declines in June. And the list is concentrated in exactly the places that boomed hardest. Punta Gorda, Florida, down 7.9%. Cape Coral, down 6.1%. Austin, Texas, down 5.7%. Northport, Florida, down 5.3%. Naples, down 4.4%. This is a Sunbelt correction led by Florida and Texas. Now, to be straight with you, that count is actually down from 89 falling markets in March. So this isn't yet a national decline. It's a market splitting in two, and on the new construction side, the crack is wider. The Census Bureau and HUD report 9.3 months of new home supply, deep buyer's market territory, with the median new home price at $398,300, down 2.7% from a year ago. Lennar, one of America's biggest builders, is spending 12.9% of the sales price on incentives just to move homes. Though buyers should note that Lennar's executive chairman called this the first real and potentially sustainable decline in incentives after 3 years of increases, a sign even the builder discounts may have peaked. Housing starts are down 13.5% year over year. Single-family starts down 15.7%. And NAHB builder confidence sits at 35, below the neutral line of 50 for roughly a year and a half. Builders are telling you with their own money what they think demand looks like. And resale inventory tells the same two-track story. Zillow shows active listings up 1.5% year over year, a 32-month streak of rising supply. Yet the National Association of Realtors just recorded the first annual inventory decline since October 2023 because discouraged sellers are pulling listings rather than cutting prices. Supply is rebuilding everywhere except where sellers refuse to blink. Real quick, if this market intel is helping you make better decisions, hit that notification bell. We drop new housing data every week, and the viewers who catch it first get the best opportunities. The bell ensures you see everything immediately, not days later when the market's already moved. Now, here's what makes this moment so strange. The national numbers still look calm. The National Association of Realtors reports existing home sales at a 4.06 million annual pace, and the median price hit $434,100 in July, up 2% year over year, the 37th consecutive month of annual price gains. Freddie Mac has the 30-year fixed at 6.67%, barely moved from 6.58% a year ago, meaning rates have gone essentially nowhere for 12 months. Homes are still selling in a median of 29 days, but first-time buyers are just 29% of the market, well below the roughly 40% historical norm the National Association of Realtors cites. So let me make that affordability math real for you. Put 20% down on the median home, and you're borrowing $347,280. At 6.67% over 30 years, that's $2,234 a month in principal and interest alone, before taxes and insurance. To keep that payment at 28% of gross income, you need to earn about $95,700 a year. And here's the trap on the other side. The same loan at the 3% rates millions of homeowners locked in would cost $1,464 a month. That's a $770 monthly gap, over $9,200 a year for the identical house. That gap is why sellers won't sell, buyers can't buy, and the market is frozen with just 4.6 months of resale supply. Which brings me to the second thing I promised you. the single number that decides whether this frozen market starts falling. It's not mortgage rates, it's not inventory, it's the monthly jobs numbers. Here's the chain. When paychecks disappear, mortgage demand drops and missed payments climb, and you can already see the early stress in the data. Intercontinental Exchange Mortgage Technology reports the national mortgage delinquency rate at 3.55% in June. Still below 2019 levels, but foreclosure starts hit 43,200, a 6-year high. FHA borrowers who are seriously delinquent or in foreclosure, 5.7%, up 1.8 points in a year. VA foreclosures, up 61%. The Mortgage Bankers Association's National Delinquency Survey shows FHA delinquency at 11.79% versus just 2.72% for conventional loans, more than 4 times higher. The lowest down payment, most payment-sensitive borrowers are cracking first, while a record $18 trillion in homeowner equity keeps everyone else from being forced to sell. That equity is the wall holding national prices up, but walls don't stop layoffs. Mortgage Bankers Association purchase applications are already down 3% from a year ago, with the association reporting that affordability concerns have re-emerged as a reason buyers are delaying purchases. Refinance applications are down 18%, and the S&P Totality, formerly CoreLogic Case-Shiller Index, shows national prices up just 0.8% year over year, which means, adjusted for inflation, American home values have now fallen for 11 straight months. July was the first month of actual job losses. Every jobs report from here on is a verdict on your home's value. So here's the big picture. Amazon's record quarter, Walmart's miss, 23,000 lost jobs, and FHA borrowers defaulting at 4 times the conventional rate are all one story. A K-shaped economy pressing down on a frozen housing market. The top half of the K is still spending. The bottom half is buying groceries on 22.15% credit cards. Housing sits locked in between, sellers protected by record equity and 3% mortgages, buyers blocked by $2,234 payments. A frozen market doesn't fall on its own. The labor market is what pushes it, and the labor market just turned. So what should you do? If you're a homeowner, you're sitting on a share of $18 trillion in equity. But if your metro is on that list of 68, that equity is already shrinking. So know your local number, not the national headline. If you're a seller in Florida, Texas, or any correcting Sunbelt market, price aggressively now. Sellers in Punta Gorda who waited the past 12 months gave back 7.9%. Every month of waiting in a falling market is a lower price. If you're a buyer, your leverage is in new construction. 9.3 months of supply and builders paying 12.9% in incentives means you negotiate everything. Rate buydowns, closing costs, upgrades. In the resale market, be patient and watch your local jobs data before you stretch. If you're an investor, notice that the smart money is already stepping back. Redfin reports investor purchases fell 6% to the lowest share since 2020. So hold cash, because the FHA stress in those declining metros is where the distressed opportunities will surface first. And if you're a renter, your window is closing. Rents are reaccelerating at 2.3%, the fastest in over a year, while apartment construction permits sit 31% below their peak. Lock in your renewal before your landlord reads the same data we just showed you. Everything we gave you today came straight from the primary sources: the earnings calls, the Federal Reserve, the Census Bureau, the delinquency surveys, not from headlines. Bookmark this video. Come back in 6 months and check every single number against what happened. That's how confident we are in this data. The next jobs report drops the first Friday of September, and we'll be breaking down exactly what it means for your home, your mortgage, and your market the moment it lands. Subscribe and hit the notification bell so the next video lands in your feed the moment it drops. And watch this one next. See you next time.